Hi, good afternoon, everybody, and welcome to Funding a Better Future. This is a new series of bite-sized episodes which feature expert insights from climate tech investors. My name is Cherry. I'm the founder of Above and Beyond Recruitment. We partner with climate tech startups and we help them to scale and grow their businesses, either by recruiting for them and helping them build their teams, or by offering talent advisory and consultancy services. This series is aimed at founders and leaders of climate tech businesses, and particularly to anybody who's looking to raise investment this year. Throughout the course of this series, we hope to give you a realistic picture of what the current investment market looks like for climate tech, as well as some tips to give you the best chances of fundraising success, and hopefully to give you a network of individuals that you can approach when the time is right for you. Today, I'm joined by Ian Thomas, Managing Director of Turquoise International. Turquoise International is a merchant bank established over 20 years ago, specialising in climate tech investments and advisory services. Over recent years, they've invested in exciting startups across EV technology, transport solutions, renewable energy, energy storage, and recycling technology, to name but a few. So Ian has a vast amount of knowledge spent from over 20 years investing in this sector, and I'm very honoured that he's joining us to share some of those insights with us today. So Ian, thank you so much for joining me.
Thank you for the invitation.
My pleasure. I've given a bit of an introduction there about Turquoise International and the work you do, but I'm sure I really have not at all done justice to the extent of it. So are you happy, Ian, to kick off by just giving us a little bit more, I suppose, a bit more context, I guess, as to what Turquoise International do?
Yeah, very happy to. So my co-founders and I set the business up in 2002, essentially to have a business of our own. We previously come from backgrounds in investment banking and consultancy, and we felt that the time was right to be more entrepreneurial and to become work for ourselves as opposed to bigger institutions. And at that time, I guess virtually nobody was talking about climate technology or even clean technology, but there was a growing awareness of an environmental issue. And we had, I think by coincidence, come across some transactions which would now be characterized as climate tech. And we thought that this was a way to differentiate ourselves from people who were in the finance industry who were focusing on things like oil and gas and petrochemicals and utilities and the sort of traditional sectors where there was a lot of competition for a new business like ours. And so hence we here we are today, 20 years later, having been through, I guess, 2 or 3 cycles in the investment cycles in clean technology. It is now, I suppose, on the cusp of becoming a much more mainstream area of the investment world, which, certainly 10 or even 5 years ago, it wasn't the case.
Absolutely. Yeah. So you were really trailblazers, I suppose, in terms of investing into that sector.
I guess so. Probably the truth is we didn't really know what we were getting ourselves into, but it's been an interesting journey. It's been an exciting journey. There have been difficult times, but I, as we sit here today, I'm quite optimistic about the next sort of 5 years.
Excellent. That leads me on beautifully, Ian, to my next question, which is having seen, as you said, a few investment cycles and been in this industry for many years now. What's your opinion of what the funding landscape looks like for climate tech today, and perhaps how is that kind of different, and how's that evolved over this last 5 years?
Well, I think that the general backdrop for technology investments is clearly much more challenging in 2023 than it has been for the past sort of 2-3 years. Having said which, clearly climate technology, with perhaps a few exceptions in the US SPAC market, for example, hasn't seen the kind of exuberance that's attached to some of the other segments of technology. So conversely, now that financing conditions are more difficult for those other companies, I don't think they are. I think the climate tech sector is somewhat insulated from that. Yeah. And probably the reason for that is that the drivers in this sector are regulatory, net zero, the Inflation Reduction Act in the US. So that benefits the climate tech sector. So I think that although capital raising this year and probably into next year is by no means easy, I do think that for climate tech companies, there is demand if you can connect with the right investors and you have the right technology at the right stage.
Yeah, fantastic. Well, that's very optimistic. So good. And obviously, climate tech being a very broad sector, and I know that you have invested in lots of different parts of the climate tech sector. Are there any in particular that you're particularly excited about for this year, both in terms of the innovations that are happening in that space, or but in terms of where you would be looking as a business to invest?
Well, we invest through our current fund at sort of seed or early Series A stage. We have about 23 companies in the portfolio, and we expect to have about 30, I think, by the time the investment period of the fund comes to an end. So for us, diversity is key, both in terms of the upside from those investments, but also risk management. So clearly, we want diversification across the portfolio. We have a number of investments in the mobility sector. For example, we have a couple in agritech, we have a couple in materials, but we don't pursue a particular strategy of focusing on subsectors. The theme for us is low carbon. That gives us the ability to invest in a multitude of different business models. We have a balance between software and digital and hardware. And we believe because net zero, for example, is going to impact all industry sectors to a greater or lesser extent, then there are opportunities across all industry sectors. And for us, we seek to achieve a balance throughout.
Yeah, that makes sense. And so what would a key differentiator be for you then in an organization that would make them one you'd be excited about?
Well, management's always important. Some VCs say management is everything. I'm not sure that's entirely right for climate technologies because particularly on the hardware side, you expect to see a portfolio of intellectual property and patents to give the business some defensibility. But management is clearly very important. And certainly one thing that has improved significantly over the past few years versus, say, 10 years ago is that management teams now are much broader, they're much deeper, and they have much more commercial experience and expertise versus simply technology expertise. So that's something important to us. I think although we're investing at early stage and companies might be pre-revenue or in early revenues, we expect to see commercial traction in some form, and that can be through partnerships, it can be through early sales, it can be manifested in other ways, but we expect to be able to assess the market drivers for the technology rather than a technology that's been developed in isolation and potentially might end up being a solution to a problem that doesn't exist. And then we're a co-investment fund, so we always invest alongside others. They may range from business angels through to other funds, through to corporates, through to family offices. So we're always working with those co-investors. Some of them may be existing investors in a business that we're coming into, or we may be the existing investor and they may be coming in subsequently. And so we're always looking to share our views and our expertise and to gain from theirs.
Fantastic. And with that in mind, is there any particular advice if any founders listening to this are potentially looking to raise investment over the next sort of 12 months or so? You mentioned there about management, about being able to kind of evidence some early commercial traction, but are there any other particular pieces of advice or areas of their business they should really be focusing in on to give them the best chances of success when they come to have conversations with people such as yourself?
Yeah, I mean, there are some fairly basic things. It's surprising how when you're inside a business, you don't automatically understand how an investor may be looking at that business and what aspects of it are important to bring forward and make sure that the investor sees. So there's certainly a process of understanding what investors are looking for and presenting yourself in the best way. And that might sound obvious, but people do fall down on it. I think the other aspect of that is spending time to identify investors who really are active in the sector that your business is operating in and at the stage you're at. That there is no real point trying to interest people who invest only at later stage, or people who focus on a handful of subsectors, and you're not in one of those. So you do need spend some time identifying investors, so that when you approach them, it's immediately apparent why they should spend some time finding out about your business. Having said that, you do need to, I think, take have a broad process. So approach more people rather than fewer. The hit rate with any one investor is always low, even for the best companies. So you should cast the net, reasonably widely. And I think you also need to be able to articulate very clearly how much money you're raising, why you're raising that amount, what that's going to enable your business to achieve over the next, whatever it may be, 12 months, 18 months, what kind of milestones you expect to hit, and how those milestones translate into a value uplift. Because investors, on one hand, aren't interested in underfunding businesses, so that the investment round is too small. It doesn't allow the company to really get to that next inflection point, and they're very interested in understanding that the next investment round is going to be on the back of success, and therefore at a higher valuation, larger amounts, and allow the business to accelerate. And I guess the last thing I'd say is, in terms of valuation, there has to be a meeting of minds on valuation. Founders often think investors or undervalue their business. Investors think that founders overvalue their business. So clearly, you need a reasonable approach where you can meet in the middle.
Yeah, that's really helpful. Thank you very much, Ian. And on that first point you made there, if you don't mind me asking a little more around that, you mentioned about the founders being able to present their business in such a way as to say the right thing, present it in the way the investors want to hear it. And in your experience, where do people tend to get that wrong, and what should they be mindful of presenting?
Well, it can take many forms. There can be an overemphasis on technology, particularly where the founders are more technically expert and biased, and underplaying the importance of the commercial side. It can be, I think in some cases, it can be a tendency to sort of exaggerate. I mean, obviously entrepreneurs are by nature optimists, so they're always going to put their best foot forward. But I think when investors ask questions, they want a fairly straightforward answer. Businesses, particularly early stage, can't cover all bases, and sometimes you just have to accept that you don't have an answer that you would ideally like to have, and you need to be sort of candid about that, rather than try to divert the question or give an answer that the investor isn't going to find convincing.
Yeah, that's super. Thank you. So I suppose not gilding the lily too much, but giving quite a realistic and kind of quantitative view on what expectations are and what can be achieved, right?
Where possible, and I think also that touches on another point, which is numbers. So for early stage companies, it's understood that numbers are forward projections are subject to all sorts of uncertainties. But I think that in order to demonstrate, for example, that you understand the market, you understand how large the market is, and not just a very sort of high level, a very large number, but actually the market that you can realistically expect to address. And then to show that, I mean, this will depend very much on what kind of product or technology or service your company is offering, but that you understand the economics of it. So you understand how much it's going to cost to deliver. If it's software, how much is it going to cost you to access the customers versus what you can charge. If it's hardware, what's the supply chain look like? What's the bill of materials, and how can that improve over time? Because clearly products that new products to the market that sell at low volumes are often quite expensive, but when you get to volume, you expect to drive those costs down. So you need to be able to demonstrate to investors that you have some understanding of all of that, even if you can't pin those numbers down exactly at this point in time.
Fantastic. That's really useful. Thank you so much, Ian, for sharing that. And what are you kind of most excited about generally? Is there anything you can share with us about what Turquoise International have got planned for this year? I mean, you mentioned some more investments there, 7 more investments, I think you said, by the end of this particular fund. But yeah, what can you share with us about what you've got going on this year?
Yeah, so we are actively looking because the investment period for our fund ends at the end of the calendar year. So we have some money available in a co-investment fund for follow-ons, but the main part of the fund needs to invest its capital by the end of the year. So we have a pipeline that we're actively working our way through, and as you said, we'd expect to make at least 7 investments in that time period. And then on the other side of our business, which, as you mentioned at the outset, is advisory. So we're working with companies who are at typically slightly later stage, looking to do capital raising rounds of, say, 5 to 25 million, and also some M&A transactions, selling these businesses to strategic buyers, so corporates who want to acquire the technology. We have at any one time sort of between 3 or 4 transactions of that type ongoing. So, and we're a team of 13 people, and some people focus on the investment side, others on the advisory side. So it is a busy time.
So people can use you and work with you on the advisory side, even if they haven't been invested in as part of your portfolio.
Absolutely. I mean, there's no link between the two. The differentiator is that the investments we make are typically we're investing up to, say, £500,000 a round. So as I said, it's at seed stage or perhaps early Series A stage, versus say a capital raising advisory transaction, which is going to be sort of 10 or more times the size of that. So the two rarely overlap, and there's no automatic link between them.
Perfect. And if people are listening to this that you know are interested in raising, perhaps at that earlier stage of their business, and are interested in raising this year, or further down the line and may potentially want to work with you on the advisory side, what's the best way for people to get in touch with you and the team?
Well, you can find us through the website. I think everybody has contact details there, email address, phone numbers. We like to think that we are responsive. Sometimes, in my experience, VCs can be difficult to access, either deliberately or because they have a large deal flow and they can't sort of always get back to people. But certainly, we make efforts to even in situations where we, for whatever reason, can't invest, or it might not be suitable for advisory or whatever, certainly try to respond to people and explain why that might be, and if we can, to direct them to others who may be best placed to help them. So yeah, by all means, do get in touch.
Fantastic. Thank you so much. Thank you, Ian, for all of those insights. That was really useful, incredibly kind of dense, information packed 15 minutes there. So thank you so much for sharing that with us. And to everybody, if you've missed any of our previous episodes throughout the series so far, we've spoken to some fantastic investors from places such as Nesta, Nomia, Forward VC, Planet A Ventures, AO PropTech, and more. And we've got more episodes coming every Wednesday and every Friday for about the next 3 or 4 weeks. So please do watch this space. Thanks again, Ian, and thank you to everybody watching. Have a lovely weekend.